Hello, my name is Nyeji Chilembo and I am managing partner for wCap. wCap is a woman-founded advisory firm that provides business support services and capital raising services to women-owned and women-led businesses in Zambia. I'm here to talk to you about foreign currency borrowing and its implications on local companies, what you need to know with respect to borrowing. I think it's a very pertinent topic to talk about today, especially in light of what's happening with COVID-19 and what impact it's having on local businesses. Most businesses are either having to shut down or pivot into a new direction, and pivoting requires funding in order to be able to do so. So foreign currency borrowing or foreign currency debt is one method to do this, and this is the purpose behind our discussion today. I'm just going to share my screen with you so that we can walk through the masterclass. Today, we're going to talk about borrowing in foreign currency versus Kwacha and what implications it has on your businesses. Excuse me. I'm going to walk you through a case study that shows the impact of foreign currency lending on foreign currency borrowing on a manufacturing business. And then I'm going to walk you through the pros and cons of foreign currency debt. I will then also take you through foreign currency risk management practices and help you come up with an outline for how you could manage your debt in debt management strategy. And we'll then close off with key takeaways that you should take after having done this masterclass. A foreign currency loan is actually a speculative deal. The borrower hopes for interest and exchange rate advantages, but that is a risky bet. I found this very interesting, very intriguing, and I think it encompasses everything that I would like to share with you today on this masterclass. So this is a case study on a local company, local manufacturing business that was performing relatively well in 2010. It had an average annual turnover of $12 million US, and they decided to borrow $600,000 at 5% from a local financial institution when the exchange rate was about 10 kwacha to $1 US. The purpose of the funds was to use it as working capital to expand its operations, to diversify their product base, and also to meet rising demand. The loan was secured by business assets such as manufacturing plants, equipment, motor vehicles, and it was expected that after borrowing this money and putting it into the business, it would give a return or a gross profit margin of about 35% on average for at least 12 months. Unfortunately, what they didn't expect to see was a movement in the exchange rate, and it led to the business going into liquidity problems. Soon after that, the value of the loan increased in kwacha terms, because this is a business that produces in kwacha or makes its sales in kwacha. So the exchange rate moved from 10 kwacha to 15 kwacha per dollar in a space of 9 months after borrowing this $600,000. The outcome was, because sales were in kwacha, it caused a currency mismatch, and the timing of payments didn't match the loan repayment profile that was applied to this particular loan. The business model also did not account for managing currency movements, and there was no debt management strategy in place. The expansion process meant that the business had to now start looking for inputs from imported markets or from import markets in order to produce its new product base. And this led to a very high operating expenses for the business. As I said before, the movement in the kwacha meant the repayment profile or the repayment of the loan in dollar terms was extremely expensive. It put pressure on the business's budget, and it became very difficult to sustain. Because of the movement in the value of the loan, the financial institution was forced to reprice it, restructure it, and instigate a margin call. When I say margin call, I'm talking about when the bank calls you and says that the security that you've put to support the loan that you have in place is actually lower in value than it should be. And so to protect the bank from a lender's perspective, they will need additional cash or collateral to protect themselves against you defaulting, in the event that you default on repaying the loan. Unfortunately for this business, it had liquidity problems and it ended up making things worse for them. The loan was eventually recalled because they didn't have enough cash or collateral to secure the loan further. As a result, the business failed and it has now gone into liquidation. So this is just one way or one impact that I wanted to show you with respect to when you have a foreign currency loan on your books, and also just to kind of point out the key issues that you should look at when it comes to borrowing in foreign currency. This is a graph that compares commercial lending rates in Kwacha to those in foreign currency rates. The blue line represents Kwacha commercial lending rates at the end of December 2020. The rate was 25% compared to the US dollar, which is the red line, which was had commercial interest rate, commercial lending rates at 3.25%. The British pound was being offered, British pound loans being offered at 2% during the same period in time. So you can see that there's a large disparity in the commercial lending rates that you will get from a financial institution. It really depends on what currency and what you're going to be using the loan for. This is a graph that depicts the distribution of foreign currency loans within the financial system in Zambia. It's recorded in US dollars by the central bank, and they report that the total value of loans and advances in foreign currency at the end of December 2020 was 944 million US dollars. This means, according to them, 47% of total loans and advances issued by commercial banks was in foreign currency, and the rest of it was done in Kwacha. Just looking at the distribution, you can see that the bulk of foreign currency loans go towards agriculture, mining, manufacturing, wholesale and retail trade, as well as the real estate sector and energy sector. So when you decide to take on a foreign currency loan, before you do, it's important to consider what advantages and disadvantages exist and what the implications are. The advantage with having a foreign currency loan is that it normally has a lower interest rate compared to local currency. We saw this in the previous graph. It really depends on the foreign currency that you intend to borrow in. It also depends on what you're going to be using the money for. Foreign currency loans can also be used to hedge against local currency volatility and inflation. And it's also a good way or a natural hedge. When I say hedge, I mean protection, a natural hedge on foreign assets. And it reduces cross-border funding transactions if one has a global-based business or an export-led business. The disadvantage or the downside to foreign currency borrowing on your business is that you're subjected to movements in market fundamentals. If there's a change in interest rates, it might result in changes in the exchange rate and the value of the foreign currency loan. Foreign currency loan can also expose the business to currency mismatches if sales are in a local currency. The foreign currency loan also leads to maturity mismatches and can give rise to possible defaults in long-term debt, especially if they're being financed by short-term investments or short-term sources of funds. Foreign currency loans also could lead to loan repricing. This is actually not just subjected to foreign currency loans, it applies to all debts. Repricing, because of market movements, can lead to margin calls, and margin call means additional cash or collateral to secure the loan facility with the financial institution that you choose to borrow from. As we saw in the previous case study, this can have some serious effects if the foreign currency loan is not managed properly. So moving on to foreign currency risk management, there are three types of foreign currency risk. One is translation risk, the other is transaction risk, and the next one is economic risk. With translation risk, this is a risk that comes about from currency conversions, and it has an impact on your financial reporting and accounts. Reporting, a good way to mitigate against this risk is to report your income and assets in the same currency as the loan to prevent currency mismatches. You could also recognize the increase or decrease in loan value via exchange rate losses or gains in your accounts. Moving on to transaction risk. This is a risk that can affect your loan contract, and it has impacts on your outstanding loan repayments. One risk mitigation measure that you could put in place is to convert the loan to local currency if it makes good business sense and if it is feasible. You could also change your business model to include foreign currency earnings so that you are able to pay your foreign currency loan in the same currency. This is something that I think would be very interesting to see right now with local businesses, especially with the African Free Trade Area being enacted and Zambia signing and becoming a member of it. There are very good benefits that will accrue from this because the new trade area provides you as local businesses with new markets and an opportunity for you to expand your businesses into new areas. The next kind of risk is economic risk. This comes about with changes in the value of your foreign currency or interest rates, and it affects future payments, especially on a long-term basis. A risk mitigation measure that you could put in place is to hedge against currency and interest rate changes using derivatives. Derivatives are simply financial instruments that are used by financial markets to protect the value of future transactions in the near future. You could use options, futures, and other types of contracts in order to protect your business. This is something that's, it's a common instrument that's used by commodity trading companies, as well as equity trading companies that you see in most places. So now that you've decided to get a foreign currency loan, it's important to have some kind of plan in place to be able to manage the situation if things go a different way. One way of trying to manage the situation is to try and restructure the loan that you have in place. Loan restructuring means you get to change the interest rate, the tenor, or the repayment profile, or you could just go ahead and refinance the loan in its entirety. To convert foreign currency loan, you could also convert your foreign currency loan to local currency and revalue the loan to maintain debt sustainability. If the debt is still unsustainable, you might want to reconstruct the balance sheet. Reconstructing the balance sheet might involve changing the capital structure of the business and also considering increasing your share of equity through shareholder equity contributions or seeking strategic partnerships from an investor that can capitalize your business. Another way, as we've alluded to earlier, is to consider pivoting your business model to include exports that will allow for foreign exchange earnings in the currency of the loan. Just make sure that the timing of payment is in line with the loan repayment profile that you choose to get. And if all fails, well, you have no choice but to sell your business to a company that's looking to acquire something in line with yours. And also, if that doesn't work, it just means that you have to liquidate your business and possibly shut it down. So that's basically what I wanted to share with you. I think there are many factors to consider when borrowing in foreign currency. I believe that the interest rates that you could get in foreign currency are definitely better than what you will get in local currency. It's just a matter of timing and also just putting in the right risk mitigation measures in place to make sure that you manage your loans or your exposure in the right way. Consider weighing the pros and cons before borrowing in foreign currency. Choose the right currency at the best interest rate and at the right time. I say this because it makes sense to have a trade finance facility, for example, in euros, if you are going to be exporting to the Eurozone. If you are going to be doing a dollar-denominated transaction, borrow in that currency, etc. And so it goes. Foreign currency loans also tend to have cheaper interest rates, as we saw in the graph before, but it can be easily negated by movements in exchange rates relative to the local currency. The good thing to remember is that currency mismatches may occur when revenues are not recorded in the currency of the loan. And if possible, you could change your business model into an export-oriented business in order to allow foreign exchange earnings in the currency of the loan. You might also want to consider the risk mitigation measures and hedging solutions required to manage exposure of foreign currency changes. Make sure you have this debt management strategy in place and use it as the right guide to take when it comes to trying to control the outcomes of being exposed to changes in foreign currency. We've come to the end of the masterclass. It has been a pleasure talking to you today. If you have any questions regarding the masterclass, please feel free to contact me at the details provided on your screens. I am more than happy to address any issues you might have. I wish you all the best in the near future with respect to funding your businesses, and hope that you have nothing but success in the near future. Thank you very much, and goodbye.